SFM. What is this, Paul? Let's look at it.
So the market cap, guys, is 2.5 billion.
Pillar number 1 is PE ratio. We want this less than 20.
Well, we got one here, a check mark here at 9.9.
Pillar number 2 is profit margin over the past 5 years. Profit margin.
This is small. It's 4%. Grocery stores tend to have lower profit margins. The gross margin here ain't bad, 37%.
Pillar number 3 is revenue growth over the past 5 years, Paul.
3.6, 4.04, 4.7, 5.2, 5.6. So definitely a check mark there for revenue growth.
How about profit growth? Pillar number 4.
129, 125, 158, 158, 150. Check mark there. It is growth.
Pillar number 5 is the number of shares outstanding. We want this number going down.
153 million down to 120. Owning a million shares 5 years ago today is like owning 1.2 million shares back then. It's a positive sign. We take their cash flow and buy shares back.
Pillar number 6 is current assets greater than current liabilities.
They have 438 million in essentially cash on hand, 510 million in current liabilities. That's an X.
How about free cash flow? The granddaddy of them all. Free cash flow growth over the past 5 years average.
110, 70, 110, 120, and 170. That is the free cash flow in terms of millions of dollars every single year for the last 5 years. The average was 117 million over the last 5 years. So 117 million multiplied by 20 is a little over 2.3 billion. So we're not far off. Now, this is part of the start. They're a new company. They were founded in 2002. So I want to see how much of their growth is organic growth, meaning how much of the growth is coming from stores that have been around for over a year, and how much of their growth is because they're opening more locations. Their original business plan was for like 240 stores, and that was it. But once they go public, people want to see growth. How do you see growth? You see faster growth by opening more locations. It ended up not working for them. They went bankrupt. But some of the things you want to look at is how much of their growth is coming from new stores versus organic growth.
Paul, do you want to pull up the momentum chart here?
So guys, remember, just recently crossed 200-day. We want to look at it crossing over the 300-day moving average. It happened here, $23 a share. So if you bought it then, you'd be in the negative right now. But the whole point is, over time, you bought a handful of stocks when the 200-day goes over the 300-day and sold when it goes below, you'd beat the market by about 1.2% a year. I think this is a stock to watch. Go do more research in terms of what their growth plan is, how their existing stores are doing, how did they do during the downturn. Natural stores tend to be more expensive. So in an economic downturn, there might be more people pulling away from them and going for more value plays in terms of groceries. So take a look at it. I'm not opposed to this one. This one looks pretty solid from a fundamental standpoint from the numbers. Now you got to look at the story behind it.